Kristine, if you look at stocks, they've had some pretty big gyrations over the last couple of days. Are we still in a buy the dip mode?
Well, Francine, I think there is a little bit of an element of that. But again, we've seen some analysis showing that that strategy of buy the dip is really showing some cracks here, particularly in U.S. stocks. We've seen a couple of consecutive 1% declines already this month for that index. And that really shows you that while there is willingness to buy the dip, there's a lot of risks that could also puncture that strategy. And especially, as you mentioned, we're heading into year end, we're heading into a period of really thin liquidity and volumes on the ground. I think there's a lot more vulnerability when it comes to risk assets. And for anyone who's expecting the dip to get bought, they may be disappointed a little bit heading into this period.
Kristine, we've got a piece on the Bloomberg today about the wall of money, the great wall of money that's going to be piling in to US Treasuries next year to potentially keep these yields capped. You're looking at the US 10-year at 146, implications, of course, of the 30-year as well. What is the read across then for equities if yields are capped at what some suggest is maybe 2% as the high that you're going to get next year for the US 10-year?
Well, Tom, I think that will certainly contribute to a bit more better sentiment in equities and risk assets, particularly in the tech sector, right? I think that's one sector that's really been flagged as very vulnerable to any spike higher in yields, especially as we enter a period of tighter monetary policy. But I think if we see yields really get capped at that 2% level, which is kind of the new era of highs for Treasury yields, which historically is really not all that high, then I think that would create quite a supportive environment for some of these high growth stocks, high value stocks that we've seen really soar in the era of unprecedented monetary policy support. And so if we see those yields moderating right around a 2% level, that certainly is good news for this sector in particular.
Kristine, in general, when you look at some of the sectors on the move, I don't know whether we can already look into 2022 if we have high interest rates, it's beneficial for banks, or how do you view some of the sector moves?
Well, Francine, it's very difficult to read into them at the moment, given, again, the year-end holiday trading period that we're in. But I think, what we're seeing is very telling, I think, of the concerns that investors have on their radar heading into 2022. Again, I think the sentiment for high growth, high value stocks, there's certainly a case to be made that could be due for a correction if we see any surprises when it comes to monetary policy, or for instance how the Omicron situation develops, and if that ends up being more negative than investors expect. But again, I think there's a lot of appetite still for that particular sector, and anything that kind of reassures investors that, look, yields aren't going to spike surprisingly higher, it's not going to be a massive sudden run up in yields, or if the Omicron situation turns out to be less dire than it initially seemed from the headlines that we've seen the last few days, then I think there's a lot of appetite still for investors to be piling into these high growth sectors here.